Okay, in my last video I was in such a hurry to end the video series that I made kind of a boneheaded move. So what I did was I watched the end of my last video and I was trying to explain the stock market very quickly, and I just made like the #1 mistake of value investing, which is you always want to look at the price of something. So like no matter how great a company makes, you want to look at its price. To make sure it's a good buy. So even the best companies in the world, to buy, if they're too expensive, it's not going to be a good investment. So I thought to myself, oh well, I better go back and look at the price to earnings ratio to make sure it wasn't completely crazy, the prices I was paying. And then I found another big mistake that I made, which is actually more important than the point I was going to make. The point I was going to make was to look at the PE ratio of any stock, right? To make sure you're not overspending for it. Okay, so in our case, what was Green Stylists was the company. Okay, so Green Stylists, the PE ratio was 15.16, and I should have checked that. I should have checked that before buying a stock. So what you do is you invert the PE ratio to the earnings to price ratio. So I have a calculator here, so I would take 1 divided by 15.16. Something's wrong with my calculator. Come on. My solar calculator doesn't work. Okay, anyway, you would take that and you would get like a percentage. So 1 divided by 15.16, I don't know what that is in my head. You've seen my arithmetic skills. It's probably like, I don't know, is it maybe 6, 7, 8%? I don't know. But so 6, 7, or 8% is like what you could roughly assume is your profit per year. Okay, so you're just taking the earnings of a company divided by the price you pay. And theoretically, that's your return on investment. But that's actually, I watched the video and I made a much bigger mistake. So yes, you have to look at the PE ratio to know if you're getting a good value on your money. A great PE ratio would be like 4 or 5. That would be like a 25% return, which is 1 divided by 4. So the PE ratio of 4, you would invert it, the earnings to price ratio of 1 divided by 4, 25%. So you could expect roughly your money back in 4 years, 25%. Okay, so enough of that. But what I did, when I was looking at the price for the stylist, Green Stylist, I was looking at the income statement. I completely, because I was in a hurry, all I was looking at was the operating profit. And then I said something like, these numbers can be manipulated, but yeah, I barely glanced. Like, this is a really good operating profit off 163 billion, but I completely I didn't even glance at the net profit, and the stock return here is negative $260 million. Now, it almost looks like a typo, so I thought, whoa, how is this guy losing $260 million per month? So I said, wow, he must own a lot of stock. So I went to Green Stylist. So here's where you want to use the balance sheet. So I clicked on the balance sheet for Green Stylist. This was after I bought it, right? I went to the balance sheet, and they own $1.9 billion worth of stock, right? And I didn't even glance at that. This is why you want to look at more than just the income statement, and or actually look at the income statement too. But so then what I'll do is I'll go and say, wow, what is all this stock that they own? So I'll go up to here to, it's on Green Stylist. I click on stock. Okay, this is who owns their stock, but this is owned stocks. So this is what Green Stylist owns. Look at all these stocks that they own, and this is the big one. Three brothers, right? They own $1.43 billion worth of stock, and it's a subsidiary. Okay, all that means is a subsidiary is they own more than 50% of the company. So they own 79% of this company. So over 50%, I think they call it a subsidiary. So how are they losing so much money? So they have a lot of stock here, right? So then what I did was I looked at Three Brothers and I said, wow, they must be losing a lot of money. Like, why is their stock going down? Let me see. Their stock was going down. What did I say it was? Last month they lost $260 million. So I went and I looked at this Three Brothers and their income statement. Look at what they're losing $42 million in operating profit, plus their stock is going. They're losing money on stocks too. So they're losing $58 million per month. So they own Three Brothers, right? Three Brothers is losing $42 million. They're gaining, so almost all of this operating profit Green Stylus is making, Three Brothers is losing it. So when I said that Green Stylus was a great buy, it was just, I didn't even look at this. I should have looked at this and I didn't, right? So what we're making in Green Stylus, we're losing in Three Brothers anyway, and then they're also losing stocks. So what you want to do when you really buy a stock, and like real life especially too, but just for the game, when you buy a company, you want to look at their balance sheet, you want to look at everything, you want to look at what they own. And Three Brothers, so like I would say, wow, why is Three Brothers losing so much money? So I'll go to I'm looking at their income statement. And you just see, wow, their operating expenses are so much more than their revenue. So then I would like look at, okay, well, what are their firms? What are their profits? So this is the company that they own now. So look at that, they're losing. So they're selling their products for less than what it cost them to make it, because they're losing it there. Even the retail store profit's not good. This is Three Brothers now. That's not a great profit margin. And oh look, they're making they're making good profit for their farms, and some on the raw materials in their apartments and stuff. But overall, you can see that that they're just not making money. So and then their stock return. So what you would do is you would look at Three Brothers and you would look at their balance sheet. They have $495 million worth of stocks. So then you would look at what stocks they own. So it's like, so the stock market's complicated. And so they own Green Stylus. So they own each other, you know what I'm saying? So Green Stylists owns Three Brothers, and Three Brothers owns Green Stylus stock. Okay, and then they own a little bit. They own Moonbeam too. And so anyway, if you really want to dig deep on a company, you got to look at what companies they own, what products they have, and everything. So just from looking at what I saw, so I just bought. So when I bought Lab Rat, me the personal Lab Rat, I bought 32 million or whatever it was dollars worth of this stock. I shouldn't have done that because I was in a hurry. I was just trying to explain how the stock market works. But in real life, yeah, you probably wouldn't, even though the PE ratio is not even that great. It's okay, depending on the industry, and the dividend yield is good. That's a good dividend yield, but that you never want to be. You want to look at a lot of different factors. So anyway, so what I know now from watching it is Green Stylus, yeah, the operating profit's great, but they're losing a ton of money, so I wouldn't buy that. So just for the heck of it, I'm going to sell this stock. So like if you make a really boneheaded move, so I'm going to say, wow, I should not have bought this stock. So I'm going to sell this. I only have 0.01%, so I'm going to sell all of my stock. I own 0.82%. So I'm going to sell all of this. I click the sell button. Okay. And there I got my $32.9 million back. So I found my mistake before it was too late, and then I lost a lot of money. Okay, and then, yeah, so I'm sorry. I didn't want to leave that mistake, because if I would have found that out later after watching this video, I would have felt like, that just would have bugged me if I would have told everybody the wrong thing. So yeah, do I want to say anything else? No. Maybe, I don't know. Should I have bought that? Weren't there 2 profitable companies when I was looking? I think there were 2 profitable companies, operating profit-wise. I think there was... Oh, look, West End. That was the last company. So West End. Okay, so I said they might have been a good company. So they were making $6 million off of $58 million, and now if you look down here, okay, they're actually still making profit. No crazy stock returns, but just for the heck of it, let's look at their balance sheet. They own stocks too. They own $25 million worth of stocks. And so we'll look at their stock. They own Green Stylus. Okay, so we just found out Green Stylus is losing money. So I don't know. Maybe it's probably not something I would consider, because I know their Green Stylus is tanking, so they're going to lose money. So, and then I could look at their I could look at their products and see, maybe I still would want to consider buying it, even though they have crappy stocks on their balance sheet. Let's look at their products. Oh, and look at that. See, now they're not as diversified. Well, they've got 3 big products. They've got desktop computer. And are they producing it? Yeah, I believe they're producing all 3 of these. So, yeah, so they've got 3 big products they're making all their money from: desktop computer, notebook computer, and sports watch. So, hey, if I wanted to take a gamble on them, at least I know what they're making. But again, that's kind of a problem to me. $22 million worth of stock and their balance sheet, but that's not that big. I mean, most of its assets and inventory and cash, so it's not. So maybe this would be a better. I mean, this might even be a better investment than Green Stylists, even though they own it. But let's see, West End Income. Let's just go to the stock exchange. Let's check out West End just real quick. Oh, they're not even giving it a PE ratio. They're saying they don't have earnings per share. They're saying that they're not earning money. I don't know why. I think they are earning money. The net profit year-to-date, they do have a year-to-date net profit, so I don't know, maybe the accounting just lagged in the game. But they should have, so 29 million, so let's just say they made 30 million last year. So 30 million, see, I'm not going to be able to calculate that. My computer's, or my calculator's dead, but, because I would have to find out the market cap of the company, but, they really are earning some money. But anyway, and then I would look at the PE ratio. If it was like fairly low, then yeah, you could consider buying the stock. But okay, now I've really said a lot, but I just wanted to make sure you always, Warren Buffett says, price is what you pay, value is what you get. So after you find out it's a good company, you then want to go back and look at the price that you pay, which that would be like the PE ratio. Okay, and you just want to make sure you're not overpaying for something, that's all. So that's all I wanted to say. All right, thank you.